Hey everyone, welcome back. Now, we're on the cusp of something really major here. I'm talking about the real mainstream institutional adoption of Bitcoin. You see, about a year ago when Bitcoin was at around $10,000 and the bull market was really getting underway, many people, including myself, felt that the 2021 bull run was going to be defined by essentially mainstream institutional adoption of BTC. So after PayPal and Square incorporated Bitcoin into their business models, and MicroStrategy and Tesla added Bitcoin to their balance sheets, many felt that it would be fairly quick before other S&P 500 companies were going to join the party. And so far, we've kind of been a little bit off with this prediction, right? In fact, we've had just 27 publicly listed companies hop onto the bandwagon, but now we have a real breakthrough. Bitcoin ETFs. They have finally arrived, and this is going to see the $100 trillion stock market, right, begin opening its big shiny doors to our tiny but mighty $2.5 trillion crypto market. $2.5 trillion, that is tiny for an innovative technology like blockchain, right? We are still in nascency. If you're watching this, you're early, right? We're all early on this crypto and blockchain journey towards mainstream adoption, towards the eventual seamless integration of blockchain technology into society. Simply put, there's no other emerging market out there with the room to scale like crypto. It's like the internet in the late 90s. We have a long way to go. All right, if you find this interesting, feel free to give me a like and a subscribe, and let's dig in. Now, off the bat, there are a host of challenges that make it hard for institutional investors to get into Bitcoin, right? So first of all, you've got the volatility, you've got a lack of transparency, you've got the fact that the markets are hardly regulated. You've also got what's known as ESG, environmental, social, and corporate governance factors that do need to be satisfied. For instance, is Bitcoin environmentally friendly, right? Also, does it go against any social expectations because companies these days are afraid of being cancelled? So what you'll find is that institutional investments are generally vetted through the company's ESG board, right? So those that fail the test, well, they don't reach the company's treasury department, right? So there's no investment. And if you look at Tesla's backflip, right, on accepting Bitcoin payments over environmental concerns a little while back, this spooked a lot of companies who wouldn't want to be seen putting profit ahead of the environment, right, had they invested in Bitcoin. Now, on top of all of this, you've got legal challenges, you've got practical challenges, right? You're basically an institutional whale. You can't just go in and suddenly buy thousands of Bitcoin. There are practical challenges as well. So to help allay some of these concerns, crypto savior, right? The crypto savior Michael Saylor, whose company MicroStrategy has amassed now over 110,000 Bitcoin, right, ran its famous Bitcoin conference in February, right, opening up its playbook to thousands of company executives around the world, teaching them how to navigate the legal, governance, and practical challenges in adding Bitcoin to their balance sheet. Now, this was a very bullish event, and Bitcoin's massive pump from February all the way to April, May reflected this. In fact, Elon Musk sent his chief of treasury to the conference, and weeks later, it was a done deal. Tesla added Bitcoin to its balance sheet, as we later found out from the SEC filings. But nevertheless, by Q4 2021, 8 months later, from our knowledge, just 27 companies have adopted Bitcoin. Now, don't get me wrong, institutional investors are interested in Bitcoin. They just need enough pampering and certainly enough regulatory protection to feel safe enough to take the plunge. Now, enter ETFs, right? This is going to drive institutional and retail adoption of Bitcoin in a couple of important ways. So firstly, ETFs, which you can think of as essentially bags of different stocks, they trade in the stock market, which is first and foremost a regulated market. This is where institutional investors are the most comfortable, right? Unlike the Wild West of crypto land, as the SEC's Gary Gensler puts it, institutional investors will be playing essentially in a safe, cozy place that they've been playing in for over 100 years, right? The stock market is a place where they're very comfortable playing in. Number two, ETFs tend to be an important staple in portfolios across the world because it's well diversified and provides safe returns. In fact, we know that the majority of individual stocks underperform treasury bills over their lifetime, right? So if you're building a portfolio and starting off, you just bought one stock, well, statistically it's likely to fail, right? So you add a second one, right? You're now more diversified, but you've still essentially got the same problem. So you add a third one, you add a fourth one, you add a fifth one, you keep going. And soon you'll come to realize that the only way to really kill the diversification risk as best as you can is to own a little bit of everything. And that's kind of where the idea of ETFs originated from in the 80s and 90s, right? So for instance, let's look at some popular ETFs. In the stock market, you have the Vanguard VTI, which is a big basket, right, of stocks. Basically, it's every stock in the US stock market, right? So that's roughly 3,500 to 4,000 stocks. Another popular ETF is Invesco's QQQ, which tracks the 100 stocks that make up the tech-heavy NASDAQ index, right? And finally, don't forget the very important VOO, the hugely popular ETF that tracks the S&P 500 index, which comprise the top 500 large caps in the US stock market. Now, historically, just holding this ETF, right, an ETF that tracks the S&P 500 index, it tends to give you better returns than investing your money in a managed fund, right? So this is why Warren Buffett keeps telling people to just buy the S&P 500, right? The great thing about investing is that it turns out often the simplest thing to do, right, is more, statistically speaking, more profitable. So in the stock market, buy good ETFs and you really can't go wrong. In crypto, buy and hold quality cryptocurrencies, right? For the majority of investors, this is going to be more profitable than trying to be too clever and trading the swings and trying to time the market, right? So in summary, ETFs in the stock market, they're synonymous with safe and sensible investing. That's their reputation. And as a result, ETFs, they play an important part in the portfolio of investors around the world, right? Institutional investors, ordinary mum and dad investors, retirement funds, and so forth. And now we finally have a Bitcoin. Well, we have several Bitcoin ETFs and more to come, such as the ProShares, right? BITO ETF, right? Which institutional and mum and dad investors and retirement funds can add to their investment portfolio, all in a regulated market space, right? The $100 trillion equities market. How great is that? Now, with all of that said, it doesn't mean Bitcoin is going to fly to $200,000 tomorrow, right? There are catches. So the ETFs that have been approved so far, they don't hold Bitcoin itself, but Bitcoin futures contracts. Right, so basically it means that these ETFs don't track the spot price of Bitcoin, but rather the expectations of future prices provided by trading on the Chicago Mercantile Exchange, or otherwise known as the CME. But the important thing is this is a start, right? It's progress, baby steps. And it should pave the way for Bitcoin spot ETFs sometimes in the future, where ETF providers will need to buy real Bitcoin, right? And this will be extremely bullish. Trillions of dollars of institutional investor money, right? Mum and dad investors, retirement funds, they're going to buy up Bitcoin spot ETFs in the future at some point, which are then forced to buy up and hold real Bitcoin, which is going to put massive upward pressure on prices, especially given that supplies of Bitcoin do continue to dwindle. Now, this is actually why earlier in the year, Tesla bulls were very and excited about the company finally being included into the S&P 500 index, because now investors who buy up the S&P 500 and S&P 500 ETF, in essence, they're going to be buying up Tesla shares indirectly, right? Whether they like it or not, which is going to be bullish for long-term price action for Tesla. Now, finally, you might be wondering why the SEC allowed all of this to go ahead at this time, right? Because one of the reasons why this is very exciting for the space is because people in the crypto space has been calling for an ETF since 2014. This has been a long time coming, right? So why has the SEC essentially not objected this time round, given its efforts to regulate the crypto space? Well, actually, this is part of the SEC's strategy to regulate Bitcoin and crypto. You see, the SEC chief, Gary Gensler, and by the way, didn't really know what to show for this section, so I thought we'd look up some memes. Nothing against Gary. He's actually probably one of the better people to be in charge of the SEC at the moment with regards to crypto. He knows crypto. He understands crypto. He actually teaches about crypto at MIT. So feel free to check out his free course. Now, Gary has actually long complained about the SEC's lack of authority to supervise and regulate the crypto space, and he's been lobbying Congress to provide him with these powers, right? Now, by allowing the futures ETF to list in his domain, right, which is the stock market, that's where the SEC's jurisdiction lies, he's encouraging crypto to move into regulated markets. And as a consequence, Gary actually has effectively gained some regulatory authority and oversight where he previously had little. Now, there are other factors as well, right? Increasingly, lawmakers and regulators are aware that there's a lot of innovation going on in the crypto space that could make the financial system more efficient, produce consumer benefit, and just generate economic growth in general. So ultimately, what's happening is the SEC is now saying, look, we're ready to trade the acceptance of mainstream crypto adoption for the ability to regulate the sector, right? Shed some sunlight onto it, reduce the money laundering threat, provide greater investor protections. Now, unfortunately for crypto adherents, right, for the crypto purists, this does sound a bit like a deal with the devil. Now, what do I mean by that? Because there's a strong libertarian, anti-government streak among retail investors in crypto, so some of these investors believe that the decentralization offered by cryptocurrencies, now cryptocurrencies did emerge, Bitcoin emerged from the ashes of the global financial crisis, will eventually blow up the financial system as we know it, right? So some of these purists, they're quite excited about this prospect for cryptocurrencies. But in reality, the direction we're going, which is the mainstreamification of crypto assets, right, becoming more regulated, right? The more regulated crypto assets become, the more they'll become just another asset class, right? Just like stocks, just like commodities, just like real estate, basically just another regulated asset class. Now, with that said, right, we've got a $2 trillion market cap versus the $100 trillion stock market. Right, so I'd say the crypto will remain the best performing asset class for the next 10 to 20 years. There just isn't a emerging market out there with the room to scale like crypto. Actually, it's amazing to see. So I wrote this article about a year ago, reminiscing on the good times when Bitcoin was only around $13,000. What a bargain that was, looking back now. Alright, if you like this video, I'd really appreciate a like and a subscribe. I hope you enjoyed the content and got something out of it. Have a great day or evening wherever you are, and see you in the next one.